Okay, dear students, this is Mustafa Mirchawala from Mirchawala's Hub of Accountancy, and today we are going to start latest past paper of March-June 25 consolidation, that is question number 1 of SBR, right? Okay, now before we move on, as usual, once again we have excellent results. You can see I have compiled almost 100 plus results for latest attempt June 25. We have 90s, 93, 90s, 80s, 70s. You can see please the whole list. List number 2, list number 3. Then we have this list. So, and yes, there are some students who got positions as well. So when they can score, you guys can also do. They also followed what we taught. They saw the same lectures. They acted upon my advice. They availed the marking facility. Definitely we send assignments and we check it, we mark it, we give feedback. Then we conduct proper mock. They did 2 mocks. The first mock which I sent, and the other one is on the ACCA website, that is ACCA pre-mock. Okay, they read the articles and they were all confident. Okay, so if you follow the same route, you can easily clear it. Okay, and especially this question is a very good question. It's a real exam question, which came in the exam, so it's a motivation. If you can understand this question, you can easily score. And nowadays I've seen they are giving very routine question. That's why the marks has been shifted from 70s to 90s now. There was a time years back, there was a time when the strategic level paper students used to score only 75, 70s. In 70s we used to have positions. Now we have positions in 90s. Okay, so because the paper is not difficult that much. Now this is the latest past paper question. Let me start read for you. E company, and the objective, there is only one objective, is to make you understand. The only objective is to make you understand each and everything. Okay, writing or typing is not my objective, sorry. EGAP is a parent company of Group. It prepares financial statement according to IFRS. Okay, the financial year is 31st December X7. This is always important data. Always, this is exam technique. Always underline, always write this date, year end. Okay, so that you can plan major things. Now, one point, exhibit number 1 is related to acquisition. The second one is IS 19, and then the third one is pre-populated thing that will be solved on the software. Right now, the first, this is the first thing. This is the first requirement. On 1st January X7, exactly 1 year before 31st December X7, your year end is 31st December X7. So 1st January X7 is 1 year before that year end. EGAP, which is parent company, paid 4.3 million to acquire 25% of the 5 million equity shares of Brine. So very important line. That means Brine company has issued total 5 million shares, total 5 million, and out of those total 5 million shares we have acquired only 25%. So right now we only have significant influence, and this company is only associate for us right now. On 1st January X7 it is your associate. Now this shareholding enabled GAP to exercise significant influence, okay, over Brine's financial and operating policies decision. Very simple. EGAP recorded the investment in Brine at cost within financial assets. Very important. We need to correct it. In the balance sheet, it is recorded under the head of financial asset. In reality, this should have been included as investment in associate. So the first correcting entry we have to make like this. See, we'll debit investment in associate. Okay, 4.3, and financial asset credit. Okay, because in reality this is investment in associate. It should have been recorded under the heading of investment in associate, but they recorded under the heading of financial asset. So we need to remove from the SOFP, we need to remove the financial asset by 4.3, and we need to increase investment in associate by 4.3. Now listen, till now it looks like this will go under the heading of investment in associate till now. Maybe after a few minutes I will teach you something else, okay, but till now. Now one more thing, they are openly saying that they have recorded at cost. See, they are openly saying that they have recorded this investment at cost, but in reality, you know, if a company is associate for you, if you are a parent company and you have associate company, then you have to do equity accounting. You have to do equity accounting, right? And in equity accounting, you need to adjust the post share. You need to adjust the post share of retained earning as well, future net assets as well of a company. Okay, then that I will do it. In the draft consolidated financial statement, no further entries have been recognized. Openly examiner is giving you hint, so that you need to do further 1 year post retained earning adjustment you have to do yourself. Now the turning point, on 31st of December X7, EGAP acquired further 45%. Now we got the control. Initially we got only 25% shares. Now after 1 year we bought 45% more shares. We bought 45% more shares. So 25 plus 45. 25 plus 45 makes 70. Now we have control. So this is the case of a step acquisition. This is the case of a step acquisition with control. Step acquisition with control. And if you have studied my lectures, I always say this is the change in status. This is the change in status. And whenever there is a change in status, the existing investment should be recorded at fair value. First, you need to bring the existing investment to fair value. Okay. And sometime I give the example of a small car and big car. It's like, just think, it's like you are buying a big new car. And in return, you are giving a small car and some cash. So now this small car should be recorded at fair value in order to calculate the correct price of that new car. Okay. So we'll record the existing investment at fair value. I'll do it, don't worry. That's my job. Now, today we bought 45% more shares, that is on 31st December X7. And how much we paid extra? Please don't sleep, please. And you are doing your exam preparation as well. Just think. So consideration comprised of cash. The new consideration we paid 15.1 million cash, and one more thing, 1 million of EGAP's $1 equity shares. Okay, so we gave two types of consideration. On 31st December X7, when we were buying new shares of 45% shares, we paid two types of consideration. One is cash and the other one is shares. Okay, and yes, that share should be recorded at fair value. So the fair value was 3.2 million. So we gave we paid 1 million. So 1 million multiplied by the share price is 3.2. So the fair value of these shares are $3.2 million. Okay, the fair value of those 1 million shares are $3.2 million. Be careful with that. Okay, on 31st December X7, now this Brian's quoted, Brian's means subsidiary company's quoted share price was $5.7. It's useful, we'll use it, don't worry. The fair value of Brian's identifiable net assets was 14 million. This is for goodwill. Fair value of net assets of S company. Fair value of net assets of S company is given because now you need to calculate goodwill. Because you got the control. On 31st December X7, you got the control. Don't worry, don't rush. Which was the same as the carrying amount in its individual financial statement. So that means no fair value adjustment. That's good. Very good. In the year ended 31st December X7, yes, Brian reported a profit. See, this is for equity accounting. I'll do equity accounting. Because this whole year, from 1st January X7 to 31st December X7, Brian was your associate. So you need to do equity accounting. And no other comprehensive income. Okay. Perfect. Okay, so first of all, okay, let me read it complete and then I'll do it, don't worry. In the draft consolidated financial statement for the year ended 31st December X7, now let's see the mistakes. I will say a few things in Urdu language as well because there are Urdu students as well. And then I'll repeat the same thing in English sometime. Okay. Now, Brian was treated as a subsidiary, very good, and accounted for using acquisition method. In the draft consolidated SOFP, NCI was measured at the acquisition at its proportionate share. They use proportionate method. They use proportionate method. There are two methods. One is full goodwill method and other was one is, so they use proportionate share of fair value of Brian's identifiable assets, net assets. However, the policy of the EGAP group is to measure the NCI at fair value. See, this is the mistake. So it's your duty to correct the mistake. Now, according to the new course, in the new pre-populated area, you need to sometimes correct the mistakes as well. So the group policy is to measure NCI at fair value, but this stupid accountant recorded at net asset share. Recorded at net asset share, right? So this is a mistake. Now, goodwill in the draft, see already they have calculated goodwill but wrong. They have calculated a wrong goodwill. I'll prove that it's totally wrong. Only they have recorded the cash consideration of 15.1C. Only this cash consideration they have recorded, the additional cash consideration. And then they recorded NCI at C, fair value of net asset. See, this is the wrong NCI. See, this is the wrong NCI. This is proportionate method NCI. Proportionate method NCI, and we need to record NCI at fair value. I'll do it. It's not, don't take tension. Then less fair value. This is perfect. Okay. And this is the goodwill. Definitely when all the above things are incomplete, many things are incomplete, then this goodwill is also incomplete. This is the incomplete goodwill. Okay. So we need no accounting entries have been recognized in respect of the issue of EGAP's equity shares, means this, see this. They have also not recorded the 3.2 million. Even you can see from this working, you can also see that they have only recorded the cash consideration. They didn't record the shares consideration. This thing, wait, this is the shares consideration. See this. So examiner has openly told you that we have not recorded the shares consideration. Can anybody of you tell what else examiner has not yet recorded? Should I tell you? The existing investment, the 25% shares, must be bring at fair value. Whenever there is a change in status, the existing investment, the small car, I say it small car, should be brought to fair value. So there is no discussion of that existing investment in this whole. So that part you have to do. So it's a total wrong goodwill. It's a total wrong goodwill calculation. We need to do it right from the beginning, and then we need to compare this wrong calculation with correct calculation, and we need to make the correcting entries. And once we'll make the correcting entries, then we'll post it. Once we'll make the correcting entries, then we'll post it. Okay, right? Giving you 1 minute to read it. Read it, please. Make the plan. Now let me show you the requirement, and then I'll first solve the practical and then the theoretical, everything I'll cover. Okay. But yes, you must know consolidation. These are revision days. You must know consolidation rules. Wait, see the requirement. The requirement number 1, see. Using exhibit 1, explain, yes, theoretical discussion with calculation, yes. And in accordance with IFRS standard, how to correct accounting treatment of investments in Brian, okay. in the consolidated financial statement for the year ended 31st December X7, your answer should include a revised calculation of the goodwill. See, the goodwill calculation was wrong, and examiner has given you hint here, arising on the acquisition of brine, arising on the acquisition of brine. Okay, so just a request, if you want to take a picture of this question, you may, because I am going to move the screen. If you want to take the picture so that it will be on your other phone as well, on other device as well, because now I'll be explaining you through timeline. See, the story is, see the story first. This is 1st January X7. Okay, on this date we bought 25% shares for 4.3 million. 4.3 million. Okay, and this only 25% shares, so we got the significant influence. So for this whole complete year till the last date, till 31st December X7, still this whole year this company is your associate. And once a company is your associate, you need to do equity accounting. So what is the post profit? Post profit is 2 million. Post profit for this company is 2 million. So how you will do it? You will write COI, that's 4.3 million, add post profit of brine into 25%. 4.8 million, 4.8 million. Okay, so this is the carrying value. This is the carrying value of investment in associate at the year end. Okay, carrying value of investment in associate at the year end. Now, what happened at the year end? Listen, at the year end, we bought 45% more shares. We bought 45% more shares. Listen, and we paid some cash consideration. Yes, for this, and we paid some shares consideration. So this is the date. This is the date, 31st December. On the morning of 31st December X7, we got the control. Okay. So at this date, we have to calculate goodwill. But what are the rules? First, you need to bring this 25% holding to fair value. This 25% holding of brine to fair value. Let me do it for you. Wait. The share price, go and check. Let me show you the share price. The share price of brine was 5.7 per share. Brine's quoted share price for one share is 5.7. Okay, so let me calculate. Wait. Fair value of 25% holding. Okay, fair value of 25% existing holding. So it's going to be 5 million shares into 25%, and per share price is 5.7. Per share price is 5.7. Let's do it. Total number of shares are 5 million multiplied by 25% into, for one share the price is $5.7. 7.125 millions. Okay, so this is the fair value. Now the carrying value, what is the carrying value? The carrying value was 4.8 at this date, at the year end morning, the carrying value was 4.8. So we need to bring this existing investment to fair value. We need to bring this existing investment to fair value. Yes, and as this is the change of status, so every gain and loss, each and every gain or loss must go in the P&L. Okay, must go in the P&L. So how much is the gain? Let me change the color for you. Gain on existing investment. Just check the difference. Just check the difference, please. Oh, sorry. 4.8 minus 2.325. Okay. So this is the gain on investment, and yes, there is a double entry for this. The double entry will be investment debit, investment in associate debit, 2.325, and yes, P&L credit. But when you credit the P&L, when you credit the P&L of parent company profits goes up. And when parent company profits goes up, the retained earning of P company or consolidated retained earning goes up. Okay. So this is one more entry. After making this entry, and yes, one more entry for this as well, 0.5. This 0.5 was also not recorded. And you better know this is very routine entry. Investment in associate debit 0.5, and again P&L, parent company's P&L credit, and when parent company's P&L credit, ultimately the effect will be on retained earning. So investment in associate debit and retained earning credit, investment in associate credit and retained earning credit. Getting? So finally, this is the fair value. This is the fair value of this existing investment. Now let's calculate goodwill in a very easy way. Just giving you 20-25 seconds. Just look at the screen. Okay. So let me calculate goodwill for you. First of all, COI, today we bought, on today's date we bought, wait, 45% shares, 45% shares. So for 45% shares, the cash consideration was, I think, 15.1 million. Okay. And then there were some shares consideration of 3.2 million. See, 1 million shares we issued, and the fair value for share price for one share is 3.2. So this is, listen, this one is for 45%. Okay. This is the 45% price. Then we'll write fair value of existing 25% holding. Fair value of existing 25% holding is, fair value of existing 25% holding is, wait, 7.125. Yes, 7.125. Okay, so this is 25%. Now just think 45 plus 25 is 70%. Now, as you know, in this question, the group policy is to use full goodwill method. That means record NCI at fair value. So what we'll do, fair value of NCI at acquisition, fair value of NCI at acquisition, Wait. Just think, in this question, S company issued total 5 million shares, and out of 5 million, now we have 70%. Parent company has 70%, 45 plus. So that means 30% shares with NCI. So out of 5 million shares, 30% shares with NCI. And what is the share price of one share now? It's $5.7. It is given in the question. Share price per share of S company is 5.7, and you know how to calculate fair value of NCI. Let's do it. It's 8.55. That's it. So this is going to be 30% more. See, now complete 100%, 45, 25 and 30, 100%. Now please add all these things, 33.975. Now simply write less fair value of net assets of Brine, S company's Brine, and that was ready made 14 million. It was perfect. So what is the goodwill? The goodwill is going to be 19.975. This is your correct goodwill. Calculation. Still something is left, but check it out. This is your correct goodwill calculation. Okay. Now take the picture of this as well. Take the picture and now we'll compare the question working. The question working, that how much work was already done by the accountant and how much was the correct treatment. So we need to adjust few things. We need to see such questions. Hope you remember the final account area of F7 FR level. Sometime examiner does half work and then you need to do remaining work. So in that question, recognition is very important, that how much work examiner has already done and how much you need to do. Okay, इसको मैं यूं बोलूंगा उर्दू में कि कितना काम ऑलरेडी हो चुका है और कितना करना बाकी है. That is very important. Okay, now let me go to the question with you. This is the question. See this thing. So see this goodwill working. Examiner has already recorded the cash consideration. Yes, but examiner has recorded NCI at 4.2. Examiner has recorded NCI at 4.2, please. So when they have recorded less NCI, so that means final goodwill is also recorded at a small amount. See, goodwill here is only 5.3. Goodwill here is only 5.3, but our goodwill was 19 point something. So now when we listen, it's very interesting. Now when we increase our NCI, because the real NCI is I think 8.7 something and they have recorded at 4.2. So we'll increase the remaining NCI. So when NCI will go up, your goodwill will also go up. NCI will go up, your goodwill will also go up. I'll make the entry, don't worry. I will increase the NCI. NCI is the part of equity. So NCI credit and goodwill debit. NCI credit and goodwill debit. This is the first correcting entry, number 1. Number 2 correcting entry. See, in this calculation, there is no existing investment. There is no fair value of existing investment. That was 7.725 something. So if I add that existing investment here, definitely the goodwill will go up. If I add that existing investment here, the goodwill will go up. Okay. So once again, you will make the entry goodwill debit, because you need to increase the goodwill, and that investment credit. Definitely whenever you calculate goodwill, you cancel all investment. So the entry for that 7.125 is goodwill debit and investment in associate, because you will say bye bye to investment in associate as well. Now there will be no equity accounting. 2 entries, and the third one is in this calculation, there is no see it is written, no accounting entries have been recognized in respect of issue of shares. So in this calculation, they have only recorded the cash consideration. The shares consideration is missing. Which was $3.2 million. The shares consideration was missing, which was $3.2 million. $3.2 million. Huh? Right? So when we record $3.2 million here, see, this thing will go up. So automatically the goodwill will go up. Okay. So what entry you will make? Goodwill debit and investment. See, they have not recorded the issue of shares. So for issue of shares, parent company will credit the share capital and the difference will go in other equity or share premium. Right? See, wait. Whenever we issue new shares in exchange, the entry is investment debit. See, investment debit 3.2. Ordinary share capital 1 million shares. 1 million shares we have issued. The face value is $1. So 1 million is the ordinary share capital, and then 3.2 minus 1 is share premium. But nowadays in your SBR paper they write other equity. This is 2.2. See, this is the original entry of issue of shares, share exchange. It's a share exchange. But you know, they are saying we have not recorded it. It's okay. So now when we record it, we'll credit these two, and instead of this debit investment, we'll directly write goodwill, because when we record investment here, our goodwill will go up. Don't worry, I'll make all the entries in one row now. I'll make each and every entry. Just see it, I'll make it. Don't worry about it. See, this is the existing goodwill calculation and the new goodwill calculation which I did. You need to compare both of them and then you need to decide. See, the real thing is understanding. The real part of the show is understanding. If you understand things, you can perform. Let me say this in Urdu. इस पुरानी गुडविल की कैलकुलेशन को नई गुडविल की कैलकुलेशन से मिलाना है और फिर आपको बताना है कि कितना काम रहता है. दिस इज द आर्ट. Okay, and I'm sure you have taken the pictures. I'm sure you have taken the pictures. You have taken the pictures. Okay. Okay, let me make final entries, final adjusting entries for you. Okay, let me make it here. Although I have already made these entries, but I'm making it again for posting purpose. Okay. The first thing was initially they have recorded 4.3 as a financial asset. In reality, it was investment in associate. So first entry will make investment in associate debit. Okay. 4.3 and financial asset credit. This is the first correction you need to do in the SOFP. Now the second correction is this entry. See, the post profits, investment in associate debit 0.5 and retain earning credit 0.5. Okay, this is the second entry, right? Then the third entry is this. See, bringing the existing investment to fair value. So investment in associate debit, how much? 2.325 and retain earning credit 2.325. Okay. Then my dear students, respected students, now all these three things, see, 1, 2 and 3, all these three things makes up to 7.125. Now this 7.125 will be transferred to subsidiary because now we have got the control. So when this 7.125 will come here, it will increase your goodwill. It will increase your goodwill. It will increase your goodwill. So what will be the entry C? See this. Goodwill debit 7.125 and all these three. See, investment, we have already debited investment in associate 3 times. Now we'll credit it. We'll say bye bye to investment in associate, and yes, consolidation goodwill accounting started. Because when you guys were kids, you studied this thing. At the time of goodwill calculation, you cancel out all investment. Okay, because now only goodwill will come. So this is one more entry. Now finally, this NCI, already in the question NCI was recorded at a wrong amount. I think it was 4 point something. So the correct amount for NCI is, the correct amount of NCI here at 8.55, and they have only recorded at, wait, 4 point, they have already recorded at 4.2. Just for your information. See, so 8.55 is the correct amount and they recorded at 4.2. So if you take the difference, now we need to increase the NCI by 4.35. Now you need to increase the NCI by 4.35. Okay, so once you will see this, once you will increase NCI here, goodwill will also go up. See the calculation, basic maths. You will increase NCI in this calculation, goodwill will also go up. So you need to make a correcting entry. See, goodwill debit 4.35 and NCI credit 4.35, because when NCI goes up, you always credit it. Okay, right? So finally, yes, one thing is left, and this 3.2 million. See, this 3.2 million we have not recorded, shares consideration. So how will you record it? Because of this line, see this, don't be a kid, because of this line your this thing is increasing, so ultimately goodwill will also go up, so goodwill debit 3.2, ordinary share capital, yes, it's a share issue 1 million, and other equity, I just taught you this 2.2. okay, so these are the all correcting entries in one frame. These are the all correcting entries. It's better you take the picture, do it according to my instruction. These are the all correcting entry which I will be posting in the software. Okay, but when I'll be going to that Excel part or software part, I won't be able to show you this screen. So it's my request to take the picture of this. Okay, all these entries. Now let me show you one magic. Listen, how many times we debit goodwill? Use your brain. We debit goodwill by this first, see this amount, here, then here, and then here. Can you add these three? See, can you add these three? Can you add these three amount? Yes, all of you please share. 7.125 plus 4.35 plus 3.2. See, this is 14.67. This is 14.675. Now see the existing goodwill of question. The existing goodwill in the question was, wait, 5.3. Yes, this is the existing goodwill in the question was 5.3. Now use your calculator. 14.675 we did additional debit. 14.675 we did additional debit plus 5.3. See, this is 19.975, the correct goodwill. 19.975, the correct goodwill. See this. The correct goodwill was 19.975. Did you remember? I just taught you. That means we made correct perfect entries. Yes, this is full of entries. Even I have recorded separate classes for double entries of consolidation. It is available in my LMS as well as on my YouTube channel. I have also uploaded it. Okay, so now we have done the calculation. The real thing is understanding. Now I'll show you how to write the theory. Very simple. General discussion you need to write. See, these are the pointers I have already made. See this. Just read it. Few pointers. EGAP company had significant influence over Brian and should have been classified as investment in associate, not a financial asset. Yes, it was a mistake. We identified, even we made the entries. As an associate, the investment should be accounted for using equity method. Yes, in EGAP's group's financial statement. Best. Then the share of profit generated by Brian since the acquisition date, this 1 year, was 0.5 million. 2 million multiplied by 25%. We did it. Should be added to the investment in associate as well as retained earning. Investment in associate debit, retained earning credit. EGAP obtained control of Brian on 31st December. Now this is the change in status. Then we have, you need to bring the previous investment at fair value, which was 7.13 million. Remember, I have written 125, but they have rounded off. No issue. Again, on remeasurement of 2.33 million should be, yes, we did this. IFRS 3 also requires all consideration, yes, to be transferred at fair value. So when we bought new shares, we gave some cash, and then we gave some shares. So that shares consideration must also be recorded at fair value, which was 3.2 million. See this thing, with the corresponding credit to equity. EGAP policy is to measure NCI at fair value, which was 8.55, already done. The NCI must be increased by 4.35. Yes, already done. Already done. Okay. So this is how you need to write it. This is how you need to write it. So this was the first requirement. Let me show you the marks for this. It's going to be 10 marks. 10 marks, pure, full of consolidation, full of consolidation. Okay, right? Now we have a proper IS 19 requirement, which is very, very good, excellent. Cash marks if you have done IS 19 using exhibit 2, explain with calculations in accordance with IS 19 employee benefit how to account for the defined benefit plan in the consolidated financial statement for the year ended 31st December X7, for the year ended 31st of December X7. Okay, so IS 19, defined contribution plan, defined benefit plan. So normally they ask about defined benefit plan. Normally they ask about defined benefit plan. Okay, let's do it. But I have a request. Please go smart. In our classes, we have taught you in detail. We have taught you 3 columns: DBO, then plan asset, and then net. But the most important column is net. So nowadays, in the recent exams, examiner directly make the net columns because you can easily make the double entries using the net column. So if you are smart enough, if your brain is working properly, then the net column is enough for you. Okay, right? So let's read it, let's break down things, let's make entries, because now in the consolidation area, the total game is of entries. The total game is of double entries. Okay, let's do it. EGAP has a defined benefit plan for its employees on 31st December X6. That means the last year. We are at 31st December, the last year. This is opening. A net defined benefit obligation of 7 million. This is the opening balance. Opening net DBO is 7 million. Don't sleep. Was reported as a non-current liability. Perfect. No problem. It's correct. In the consolidated statement of financial position. Excellent. On 1st of April X7, after just 3 months. From the beginning of the year, open your eyes. The plan was amended. The plan was to provide additional past service costs. Hope you remember amendment in plan. We'll increase the benefits for employees. With effect from that date. Okay, so that means this is a special case. In the mid of the year or after 3 months, there is a change in the plan. So it will change your net DBO. When it will change your net DBO, so you need to calculate interest for first 3 months separate and last 9 months separate. There will be a separate calculation for first 3 months and last 9 months. Use your brain because your DBO balance has been changed. Okay. The present value of the additional benefits on 1st April X7 was 4.2 million. See, this is past service cost. And you know the entry for past service cost? The entry for, just giving you revision, I'll make it. The entry for past service cost is P&L debit and DBO, net DBO credit. P&L debit and net DBO credit, I'll do it. Even I'll post it for you. After that amendment, excellent. The plan was determined to have a net obligation. See your DBO, the new DBO is here. Why examiner is giving you new DBO? Because for the last 9 months you need to calculate interest again separately. For the last 9 months you need to calculate DBO on this, or you need to calculate interest expense on this 12.19. But for the first 3 months, use your brain, you will be calculating interest on this. 7 million. You will be calculating on interest on this 7 million. Because of the improvement in terms, the monthly service cost, excellent, change from 0.3 million before 1st April X7 to 0.35 million per month after 1st April X7. Excellent. Hope you remember current service cost. They have also revised the current service cost. So in the first 3 months, of the year, the current service cost is 0.3 million per month. But after 1st April X7, the current service cost is 0.35 million per month. So in this question, we will be doing two calculation for current service cost, first 3 months separate and last 9 months. See, let me write current service cost. Wait, for the first 3 months it will be 0.3 multiplied by 3, and then for the last 3 months it's 0.35 multiplied by 9. Very simple. This is the first 3 months and this is last 9 months. Easy. You are not kids, you are doing jobs in big firms, so active mind. Now, the interest rate on high quality corporate bonds, very good, was 5% on 1st Jan. At the beginning of the year, the interest rate was 5%, but this rose to 6%. That means there is a change in interest rate as well. See this. So for the first 3 months, the interest calculation will be done using the interest rate of 5%. And for the last 9 months, interest calculation will be done using 6%. Easily we'll do. If you have confidence, I'll do it for you. At 31st, the actually valued, see, the year end defined, the closing balance of DBO is 10 million. The closing balance of net DBO is 10 million. I'll use it as a closing. The only accounting entry posted in the year in respect of the above was to recognize cash contribution. Yes, in this year they have contribution by employer. Contribution by employer in the plan, is 4.1 million paid into the pension plan at 31st December X7 in the consolidated. Wrong treatment, wrong. See, we are doing defined benefit plan. And whatever contribution we are paying, even I teach this thing in class like a beginner to you guys. See, whenever you pay contribution, whenever employer pay contribution, cash goes out. So cash credit and plan asset debit. And we are making third column directly. There are 3 columns: DBO, then plan asset, and then the net column, net. So if you are working through only one column, the third column, if you are working through only one column, then the entry should be DBO, net DBO debit and cash credit. So for this 4.1 million, see, you should have made the entry net DBO debit 4.1 and cash credit 4.1. But this is stupid, sorry to say, this stupid accountant made the entry P&L debit. So now you tell me, some of you guys have been taught by me when you were kids, suspense account, errors accounting. I teach errors accounting. Even on YouTube I have posted many lectures of errors. So can you tell me how to do it? The third, this entry is the correct entry, this is wrong entry. So what should be the correcting entry? The correcting entry will be net DBO debit 4.1 and PNL, or PNL means retained earning. PNL means retained earning credit 4.1. So this is the correcting entry. I'll post for you. I'll do it for you. This is the correcting entry. I'll be doing it for you. Don't worry. Don't forget, this is the correcting entry. We need to post in the final pre-populated area. Now I have just given you some introduction, the starter point. I'm going to solve it for you. Everything I'll solve it for you. Don't worry. Just see it. Better you take the picture. Extreme level spoon feeding I'm doing with you guys. Okay. I'm sure you are much more intelligent, but during teaching I consider the lowest student as my standard. Please take the picture. Now, you have taken the picture. I'm sure you have taken the picture. You have taken the picture. Okay. So now I'll be using the other screen. I will be using the other screen. See, first of all, we'll write opening net DBO at 1st January X7. You can also write 31st December exit, but 1st January X7 is the starting point was 7 million. Okay. Now, first I'll do 3 months accounting separate, then 9 months. First 3 months and then 9 months. Listen, and you'll see some reconciliation type of thing as well. So the first thing is current service cost. For 3 months, the current service cost is 0.3 million multiplied by 3. 0.3 million is the one month current service cost multiplied by 3 is 0.9. Okay, and you better know the entry for current service cost is expense debit and net DBO. This is the net column. Okay, now we are making the net column. Finally, net column, this is the net column. Then we have interest expense. Wait, interest expense will be for the first 3 months, the outstanding amount is 7 million. This is the outstanding amount. Okay, 7 million, this is the outstanding amount. So 7 million into the rate is 5% per annum into 3 upon 12 into 3 upon 12. This is going to be 0.09. Okay, now then we have a past service cost. Amendment in plan happened, and past service cost is also your expense. So expense debit and net DBO credit, it was 4.2 million. Now just you will see a magic. All of you please add these 4 things. If you add these 4 things, you will get this 12.19. Okay, this is the net obligation at 1st April X7 at 1st April, net obligation at 1st April, net obligation at 1st April. Okay, and they gave you this 12.19 ready made. They gave you this 12. See the question, let me show you. If you have the pic, you can see. Wait, I'll move the screen. They have given you ready made 12.19 just for your easiness. Wait, see this. See this. See this 12.19 is given ready made. That's a good part of them. Okay. Now we'll do last 9 months. How we'll be doing last 9 months? Then you have again current service cost. That will be 0.35 per month. 0.35 multiplied by 9 months. Okay, 0.35 multiplied by 9 will give you 3.15. Okay, then you have again interest expense for last 9 months. Now can you use your brain? Now your outstanding loan is 12.19. For the last 9 months, the outstanding loan is 12.19. So 12.19 multiplied by, now the rate is 6% per annum into 9 upon 12. So this will be 0.55. Okay, right? Now my dear student, you have a contribution paid into the plan. So contribution paid normally increases your plan asset. It increases your plan asset, but it decreases your net DBO. So 4.1 million should be deducted from here. 4.1 million should be deducted from here. Okay, finally listen, the way I taught you in the class. Finally, your closing balance of net DBO at year end was 10 million. Okay, now let me change the color. Here you will get remeasurement component. Okay, Very simple. Just start from here. Start from here. Don't go from the top. So it will be, wait, all of you, you guys can also use the calculator. It will give you involvement feeling. 12.19 plus 3.15 plus 0.55 minus 4.1. So the closing balance should be 11.79. The closing balance should be 11.79, but here it is written 10. See, the closing balance should have been 11.79, but here it is written 10. So that means there is a sudden reduction of 1.79 in the liability, sudden reduction of 1.79 in the liability, and it is good. It is good when liabilities goes down. It is good when liabilities goes down. So it's a gain. It's a remeasurement gain. Remeasurement gain. It's a balancing figure. And yes, it goes in OCI. We all know this thing goes in OCI. This thing goes in OCI. Okay. Now I will make one comprehensive entry, only one big comprehensive entry for you, and then I'll explain you how to post it. No worries. Okay. If you want to take the picture, you are most welcome. Always welcome. Listen. Let me make double entry here. I'll make entry here. See, first of all, there is a current service cost of 0.9 and 3.15 total. I'm making entry for the whole year. So 0.9 for first 3 months and then 3.15. If you add these two, it will be 4.05. It will be 4.05. So current service cost is your expense. Okay. And expense goes in retained earning. In short, expense goes in P&L or retained earning, whatever you say. So current service cost expense debit by 4.05. This is the first expense. Also, interest is also expense. See this 0.09 and then 0.55. So interest expense also goes in retained earning. So it will be 0.64. If you add the whole year expense of interest, it's 0.64. Then you have past service cost, PSC, past service cost, amendment in plan. Also, this is your expense, so it will go in retained earning, which is 4.20. So all these three things are your expense. I'm making the original entry. I'm just making the original entry right now. Okay. Now, then definitely you paid the cash. So cash credit, how much? 4.1. I'm making original entry the first time. And then there is a gain, the remeasurement gain. So OCI will be credited. As this, it is a remeasurement gain. So OCI will be credited. So OCI credit 1.79. And finally, listen. Finally, what was your, they have written, they haven't made any entry except this 4.1. See, your opening balance of DBO was 7 million. Your opening balance of DBO was 7 million if you remember the class, and now the closing is 10. So how much is your DBO is moving? Sorry, how much your net DBO moving from 7 to 10? From 7 to 10, it is going up by 3. So your net DBO, the liability will goes up by 3, so 3 credited. Now student, it's a magic. Please, I would say this is a magic. Please see this, add both sides of entry. Did you balance it? Add both sides of entries. Do it. 8.89. Yes, both sides are same. Now we have done the practical part now, but the last part of this question is left. Wait, and theory reading is also left. Wait, relax. We have to make all these entries. We have to post all these entries separately. Wait. Let me show you. See, if you have taken the classes, you remember there is a separate entry for this, and this. What are the entries? This current service cost is an expense. So expense debit and net DBO credit 4.05. Expense debit means retained earning. We are doing a balance sheet question. We are doing SOFP question. So expense debit or retained earning debit for current service cost and net DBO credit, non-current liability. Then interest expense will again go in retained earnings. So retained earning 0.64 debit and net DBO credit. Then for past service cost, again it's an expense. So retained earning debit by 4.2 and net DBO credit. These three entries you have to make. These three entries. And then you have to make one entry for OCI. See, OCI is going on this is the net entry. This is the overall net entry. Only one entry we made. For this remeasurement gain, the separate entry will be this like this. See, OCI credit 1.79 and net DBO debit. Net DBO debit 1. This is the separate entry. So this entry I will also post. So how many entries we have taken out? 3 entries. First, current service cost entry, interest expense entry, past service cost entry, and all three has got the same entry. In fact, retained earning debit and net DBO credit, the non-current liability. I'll do it 3 entries separate. Okay, and then we have remeasurement component is 1.79 and that's a gain. So OCI credit and net DBO 4 entries. These 4 entries you have to make and post, and finally one correcting entry like this. Wait. Finally, this is the correcting entry. Finally, this was the correcting entry. There was a mistake. There was a mistake in the question as well. Now, as a student, you may ask, sir, why you are not making entry? Why you are not posting any entry for cash? Because they have already recorded the cash. See, they have already recorded the cash. See, was to recognize cash. See this, already they have made the entry for cash. See this. So this entry I will also post. So total 5 entries. Be careful. You have to work hard. You don't have any other option. You don't have millions of dollars. You have to study. You have to find a good job, good industry. This is the routine cycle, right? So my respected students, my dear students, this is the first correcting entry, net DBO debit, retained earning credit first, and then 4 entries you need to make. 4 entries you need to make from here. Total 4 entries from here. Current service cost, interest entry, net interest component entry, past service cost entry, and remeasurement. Total 5 entries I have selected. And I'll be posting it. Take the picture if you want. And now finally, just read this because we need to discuss as well for part B. See, an amendment to a defined benefit plan that increases the obligation is a past service cost. We know that, which should be recognized in full as an expense when the amendment occurs. When a plan amended occurs during the reporting period, interest of the remaining period is calculated based on the remeasured net at the year, right? If it happens in the mid of the year or after a quarter, so that means you have changed the net DBO. So you need to do 2 calculation of interest. You need to calculate 2 types of calculation for interest because the obligation has changed. Interest for the first 3 months should be calculated based on the opening net obligation and the rate is 5%. Already we have done. After the pension plan amendment on 1st April X7, the applicable interest rate is 6%. And now this is the new interest. Already we have done it. Already. The plan amendment on 1st April X7 also causes a revision in the monthly current service cost. So whatever we have done, we are writing it. So now it will be 0.35 per month. So 0.35 multiplied by 9. This is for the last 9 months. And the total current service cost is 4.05. Already we have done. Then this is the error. See, this was the error which we need to correct. See, cash contributions of 4.1 million must be removed from profit and loss and instead treated as a reduction in net pension deficit, net DBO. We already made the entry. Then the gain on remeasurement of 1.79. The gain on remeasurement of 1.79 is recognized in OCI and will not be reclassified. Yes, this type of OCI will never be reclassified to PNL. We know that this type of OCI will never ever be classified to PNL in future. That's it. So all both requirements we have done. Both requirements we have done. First requirement was 10 marks, then 8 marks. Now finally the favorite part, easy part, because we have already worked hard for that. We have already worked hard for that part. So now we have to post those entries. Let me give you a very clear instruction. Total 5 entries for IS 19. I have showed you multiple times. You should have taken pics. And then how many entries for consolidation? These are the entries in one frame. All 7. 1 2 3 4 5 6. 6 entries. 6 entries for consolidation. Okay, so 6 plus 5, total 11 entries, and done. You are done. Just post total 11 entries and bye bye. 11 entries only 11 entries. That's it. So your wish, take the picture of this and then take the picture of this as well. It's better you take the picture. I will upload the slides in my LMS. Don't worry, but still, right now you are doing the question because now I'm going to change the screen. I will not be able to come back to this screen now. Now I'll go to the Excel part, the pre-populated area. The pre-populated area. Let's go. Let's do it. Okay. So now this is the pre-populated sheet. Now what will be given to you in the examination? First listen. This first column, these all things, and this first column, the draft column, this column, see, this column will be ready-made given to you in the exams. Okay, but these headings you need to write yourself. See, in the top, these top headings you need to write yourself. Okay, now we have total 6 plus 5, 11 entries which we need to post. 11 entries which we need to post. Let's start. See, first of all, financial asset, they recorded wrongly 4.30 financial asset. So we need to subtract 4.3. Oh, sorry, we need to subtract 4.3 from here. Wait, okay, we need to subtract 4.3 from here, and then financial asset credit and investment in associate debit, and we'll debit 4.3 here. Okay, right? So first entry posted, done. Then we have the second entry. Wait, first I'm solving all consolidation. Then investment in associate debit 0.5 and retain earning credit. Investment in associate debit, that means 0.5. 0.5 we'll add here in front of investment in associate, and retain earning credit 0.5. So we'll add 0.5 in front of retain earning. Be confident. Then we have third entry. We have third entry, bringing the existing 25% investment to fair value. It was, I think, 2.33. I'm writing 2.33, right? So 2.33, investment debit, investment in associate debit 2.33, and retain earning credit 2.33. Okay, right? Retained earning credit 2.33. Now finally, this is the entry. Now we are going to post all entries for goodwill. So for goodwill there were three entries. Listen, the first entry for goodwill was 7.13. remember, investment in associate credit, bye to investment in associate, and goodwill debit. So 7 7.13. Yes, 7.13 will be added here and 7.13 will be subtracted from here. Okay, see this. Investment in associate credit and goodwill debit. Now, there was one more entry and the NCI adjustment. Because of NCI adjustment, 4.35 goodwill debit and NCI credit. Goodwill debit and NCIS. 4.35 goodwill debit and NCI credit. Hope you remember. Then there was a share issue of 3.2. So 3.2 million goodwill debit 3.2 and share capital credit by 1 and other component of equity by 2.2. Okay, goodwill debit, ordinary share capital credit and other component of equity credit. Okay, so finally I have posted all 6 entries of consolidation. I have posted all 6 entries of consolidation, but yes, now we have 5 entries left. 5 entries left for IS 19. Let's do it. So the first entry is current service cost. Interest entry. Interest entry was retained earning debit and net DBO credit, and it was 0.64. Yes, so minus 0.64 retained earning debit means reduction in retained earning, and net DBO is your liability. See, non-current liability 0.64. Okay, then current service cost. For current service, they have written service cost. So service cost means current service cost. Listen, current service cost plus past service cost. There were 2 service costs, current service plus, you can write it separately as well and you can combine it as well. So current service cost was, past service cost was 4.2 and current service cost was 4.05. So if you add current service cost and past service cost, it makes 8.25. So 8.25 retained earning debit and DBO credit 8.25. Sorry. Okay, right? DBO is non-current liability. Okay, then we have, hope you remember one error. So I have combined 2 entries, current service cost and past service cost. I have posted as a single entry. Interest I have posted separately. Now there was an error. Hope you remember the error of contribution. So the error is retained earning credit. For correction of error, retained earning credit and net DBO debit. So it's going to be 4.1. Retained earning will go up by 4.1 and the liability will go down by 4.1. Yes. And finally remeasurement component. OCI remeasurement, there was a remeasurement gain. Remeasurement gain means your OCI will go up, your OCI or your OCE will go up, your OCI or OCE will go up and your net DBO will go down. Okay, so finally we have posted all entries. Let's calculate the last column, revised column. See, so the first line is property, plant and equipment, no change, so it will come as it is. Then we have then we have the second column is financial asset, 15.7, done. Then we have the third column, investment and associate, it's 15.20. yes, after everything. Then we have a goodwill column, 31.08. Perfect. So if you add all the above, it's 175.68. Perfect. Then you have current asset, yes, then you have current asset. I think there is no adjustment in current asset, so it will be as it is. And now the total assets, 221.98. My dear student, please have a look. Relax and have a look. Check it out. Okay, now we have other equity, other side, the share capital. The share capital side. Wait, I have done a little posting error. Yes. Wow, sorry. These two, this 2.2, uh, it, it will come here. No, it's other. Sorry, 2.2 is perfect, but yes, 0.64 will come here. I've just done the alignment error. Control X. Yes, retain earning. Instead of retain earning, I have posted few things in. Instead of retain earning, I have posted few things in other component of equity. Okay, this will be posted in other component of equity. Okay, now it's perfect. It's perfect. Okay, so first of all, share capital. 80 plus 1, 80 plus 1, 81. Then we have other component of equity. Yes. 15.99. Yes. Then we have retained earning. Then we have retained earning C. Horizontally we need to add 43.64. Perfect. Okay, now add these three. 140.63. Then we have NCI. Yes, there is some adjustment with NCI for sure. 23 plus 4.35, 27.35. Then again 167.98, 167.98. Finally you have non-current liabilities. 33, and you have current liability. Okay, now let's finally conclude it. Done. It's balance. Now as a student you may think, sir, this last requirement is of 12 marks and we did it in just 5 minutes. Yes, because we already worked hard for this requirement. We made the entries for this requirement already. Okay, so already the hard work was put in during the lecture. Okay, right? Please check it out. I hope you understood this. It's not difficult. It's all need practice. Honestly, it need practice, and this is scoring area. Consolidation, I always say this thing, consolidation gets you clear in SBR. It's easy marks. Just practice your kit, just practice your study hub. Watch my past papers, pre-mock. You will be master of this. Okay. So if you like this class, please comment on the class, and also you can share with your friends. Thank you and take care. Bye bye.